Hello and welcome to Hot Commodities, and we are doing a gold special on the show today. I'm Manisha Gupta and the top headlines we are working with are: the gold prices today tread cautiously with prices just about holding 1125 to a mark. Remember, the global equities are rebounding as China's economic concerns gradually fade, and this in turn is denting the precious metal safe haven appeal. And the gold purchases in India, remember 45% of gold buying in India is an exchange of old jewellery or coins for new, and investment demand is currently witnessing a downward trend. And all other commodities also see a rebound today. The crude oil prices are up for a second straight day. US crude prices are above $40 a barrel, and the base metals witness support buying. Remember, this is all due to global markets stabilizing today. Well, let's talk about the gold prices first of all, and they have been on a very volatile mode. After the Chinese yuan devaluation, you saw the prices gain up all the way to 3-month highs. But since then, since the stimulus has come in, there has been pressure that has come back in case of the prices. But having said that, it still continues to be on the higher side. This perhaps could be a third straight year of decline coming in for gold. But most long-term analysts would tell you that the prices still are at a good buy at these current levels, because we haven't seen prices decline below or keep a long term below $1110 per ounce there. Where are the gold prices headed, of course, is the question that would be asking there. Let's get in the gold holdings in the various countries, and that, of course, continues to be on the upswing trend there. In January, we've seen 32 tons of gold coming in. The major month, of course, has been the month of March, when you saw the gold imports at 117 tons. We still are, of course, awaiting July and August imports. Markets are expecting that going forward in the second half of this year is when you will see an uptick coming in for the gold imports. Having said that, it also is going to depend upon the monsoon. That would impact the rural buying for gold. And of course, when it comes about the gold reserves, India, of course, stands 10th in the line there. The highest and the top holder of gold in reserves in sense of the central bank is the US, with nearly 8,000 tons of gold holding on to that one. But let's get on board Sanjeev Agarwal. He is CEO, Gitanjali Export Corporation. And also joining us on the show would be Henk Potts, Director, Wealth and Investment Management at Barclays. And of course, we have a very special guest, Jim Rogers, commodity expert and author, Street Smart's Adventure on the Road, to discuss China's impact across global commodities and, of course, particularly in gold. Sanjeev, let's start with you first. And what's your sense really coming in? The global prices are settling slightly on a weaker note right now. What's your sense on where are we headed from here on?
Well, as far as the gold prices are concerned, I personally feel that it's sort of going to stabilize at the $1,000 to $1,200 per ounce level for some time. There will be fear factor which will continue for some time, given the fact that the expectation of a further drop in gold prices in the international market has been bellied by the devaluation of the yuan, and the fact that the interest rate increase move that was going to happen in the US has been postponed. So yes, there will be a wait and watch to which direction is the gold going to take, and that will be only decided over the next 3-4 months as I see it.
Let's get on board then Jim Rogers, and he joins us live as well. Jim, hi, it's such a pleasure always to get you. What do you make of what we've gone through in last couple of weeks? The Chinese yuan devaluation, and then, of course, a stimulus coming in from them and a rate cut as well. How do you look at the China story right now?
Well, Manisha, first of all, this is not a devaluation. I'm not sure why people outside of China say that. For many years, the American government and the IMF and me and others have said, please let your market determine what happens to the currency. So finally, the Chinese said, okay. It went down 2% one day, 1% another day. That's not a devaluation, Manisha. The Japanese yen is down 50%. The rupee goes down a lot more than that kind of. The American dollar fluctuates more than 3% quite often. So it's not a devaluation. It's market forces, and 3% is not very important to anybody, including China. But to answer your question, what happened in China was the markets went up much too much. They tripled in a year, and now we're paying the price. Partly we're paying the price because of excesses by central banks all over the world, and we all know that those excesses are going to be coming to an end before too much longer. And Manish, I point out to you, the American stock market is down more this year than the Chinese stock market. So I don't quite understand all this hullabaloo about China. The Chinese are not happy, the ones who bought at the top. But this is not very important. Very few foreigners own Chinese shares.
Fair point. Yes, we've seen a lot of people actually talk about how you should be buying Chinese shares. But couple of data points, Jim. One side, there have been various reports, and of course, I want to get your view on that the Chinese growth is at the slowest pace since 25 years. What's your sense on that? And number two, we have seen Chinese yuan perhaps, perhaps was overvalued. Do you think these are a couple of points which are working in the market right now?
Well, there's no question that Chinese growth has slowed down, partly because, growth around the world. You look at Europe, you see what's happening in Europe. Europe is a gigantic customer of everybody. And Europe is certainly not doing well. Many parts of America are not doing well, except that people are getting, all the printed money. And likewise, Japan, too. Japan is one of their largest trading partners. So, yes, everything is slowing down in China, which is normal. It has been 25 years since not 25, but it's been a long time since they've had a big slowdown. They should have a big slowdown. It's abnormal that they have not had a big slowdown. So I don't worry about it. I bought some Chinese shares when they collapsed. They collapsed some more since I bought them, but I'm not particularly worried about the end of the world yet.
Jim, also China is a big guzzler when it comes to commodities. It consumes nearly 50% of global metals and nearly 30% of all agricultural commodities, 1/8 of crude oil global demand as well. The kind of decline that we've seen coming in for all of these commodities clearly has seen a major decline because of what China has been going through.
Yes, China and the rest of the world too. You were exactly right with your statistics. They have been a major consumer of especially metals, there's no question, and the slowdown is affecting metals, especially since with some metals there was a huge increase in supply. The iron ore produces minutia, as you well know, minutia, the expanded capacity dramatically. To my astonishment, they're still expanding capacity. So yes, we're having oversupply in some things, especially iron ore, and probably will for a while.
Jim, you mentioned about US as well, and yes, lots is going through there as well. And there have been various reports on how perhaps US might want to delay its rate hike even more after especially what we've seen going through in the emerging markets.
Well, Manisha, you're right. Unfortunately, when the bureaucrats and the academics in Washington see markets going down, people call them up and say, oh my gosh, you must save us, you must save us. Well, they're not very smart, they're bureaucrats and academics. So they think that the world's coming to an end. But again, Manisha, the market's only down 10 or 12% this year. That's not a very big decline. But they don't understand that. They will do something. They will delay the rate increases. And if it gets worse, Manisha, they'll do something else. I don't know. There'll be another QE something. They probably call it a different name, but they will do something to save the market. Then the markets will have a big rally. But Manisha, that's probably the last rally, because then the markets are going to realize, oh my gosh, this is serious. All they know is to print money and to go deeper into debt, and that cannot last.
Jim, we talked about currencies as well. What's your sense coming in for that one? Because the world really seems divided as we stand. We, of course, have seen a decline coming in for the US dollar index also. But take a look at euro, up nearly 7% in the basket of 10 currencies in last 3 months. Even as we've seen all of those Greece problems going through, euro really has sailed through quite strongly.
It certainly has. It certainly has. That's partly, Manisha, because it went down so much. My largest long position is the US dollar. I do own some euros, but I own more of the dollar because I suspect we're going to have more turmoil in markets in the next year or two. And during that time, many people will flee to a safe haven. They think the US dollar is a safe haven. It's not, but people think it is. So that's why I own more US dollars than I do euros, although I do own some euros.
Jim, what's your sense now coming in for the gold prices? Because as a reaction to emerging markets, we did see the prices go up to 3-month highs. It hasn't been able to hold on there.
Well, I've hedged some of my gold. I haven't sold any gold other than hedging some of it. In my view, it's too early to be buying gold. There will be another chance to buy gold in the next year or two, next month or two, who knows when, at which point I hope I'm smart enough to buy a lot more gold. But I'm not a big buyer, not now, Manisha.
Ranges that you're working with in sense of gold then, Jim, do you see $1,000 breaching on the lower side?
I do, and I do indeed. Or if that's my expectation. If it doesn't happen, it's okay. I own plenty of gold and silver. I suspect it may go under 1,000. If so, I hope I'm smart enough to buy a lot more.
Jim, also, what's your sense now coming in for the crude oil prices? Because that commodity or that sector really has seen a very sharp decline, down 70% from last year highs. We're just about holding $40 for the U.S. crude now.
Well, when you have a big collapse like this, and you have a dead cat bounce, as we call it in the U.S., then you go back and you test the lows. We're now testing the lows. They may make oil may make new lows just to scare everybody. But Manisha, we're in the process of making a bottom in energy prices. The world's reserves of oil continue to decline, except for frackers, and frackers cannot make money at $40 oil. So the fundamentals outside of fracking are in decline. So I would suspect it will make the bottom sometime this year or next, and then oil will go higher again.
Jim, how would you look at India? Because in the emerging markets, we've been still standing tall as a relative performance. What's your sense when it comes to the Indian economy, equities, currency as well?
Well, I bought Indian shares when Mr. Modi came along because we all had confidence in what he said and what he had done before. I have since sold them, Manisha, because either I got tired of waiting or I didn't believe he was going to do anything. He's been there a long time now. There's been very little substantive action taken, so I have sold my Indian shares.
Jim, how would you look at the Indian rupee as well? Because we've seen a lot of volatile moves onto that one. 2-year lows successively for 2 weeks. But this week, of course, seems to be getting some sanity back.
Yes, well, one of the advantages that India has, other than a lot of smart people, is that your central banker is probably the best central banker in the world, or at least the least bad central banker in the world. I always admire what I read when he says things. Unfortunately, he is not the Indian government, and he cannot save India. But you certainly have the least bad central banker in the world, and I hope he continues. Now, he cannot do everything. India has a lot of debt. India has a lot of internal problems, but I'm delighted to see him. I don't own the rupiah, but I am certainly watching what he does and what he says.
Jim, one more question before we let you go. And what's your sense on the base metals? Because this has been yet another sector which really looks up to China's growth, numbers, economy, everything. And this sector really has been beaten blue.
Well, it certainly has, Manisha, and that's partly because of the Chinese situation. One thing that happened in China when markets were going straight up was that a lot of people borrowed money against their metals and then put it into the stock market. And needless to say, then they couldn't sell many of the shares because they stopped trading. So they had to dump their base metals. In my view, we're probably seeing the same thing as with energy. They're making a complicated bottom, and that things will probably be better. It's more likely with energy, given that production reserves continue to go down. With base metals, we had some capacity added in the past few years. I would suggest that oil will make its bottom, but base metals will too during this period.
On that note, Jim, we'll let you go. Thank you so much for coming by and giving us your views on all of those commodity and, of course, economies as well. Always a pleasure to have you.
It's my delight, Manisha. I hope we can do it again sometime.
Look forward to that, Jim. Thank you.
Bye-bye.
Let's get Navin Mathur on board as well. And Navin, you heard what the global commodities are looking like, but the Indian markets really have a double whammy. Not just the international prices are moving, we also have seen rupee being quite volatile as well. So what's your sense on how should we be trading in the base metals and precious metals? Because these two areas have been quite volatile on both sides.
Absolutely, Manisha. I heard about what Jim was talking about, and I think his pointers are very valid with respect to the global markets and the economy. He also talked about the Indian rupee and the way the Indian rupee has been volatile over a period of time. I think the Indian fundamentals remain very, very positive among the emerging market pack. although the government has challenges across to put the reform measures, but if you see the macroeconomic indicators, they are all positive except for growth in exports here and there. But all the other major factors are positive for India, and I think the rupee would stabilize at around these levels. Yes, there was a volatility over a week time or 10 days because of the Chinese factor and the emerging markets consequently behaving the way we have seen the volatility in the markets. But overall, I think the rupee should be at a level of around 65, 66 with all the positives built into. With that, Manisha, the bullion pack looks to be kind of stabilizing at around 26,000 rupee level on the 10 grams for gold, and I think 33 to 35,000 rupee level would be good for the silver prices to stabilize on the bullion pack. Overall trend, definitely because of the currency factor and because of some kind of a knee-jerk reaction on the Chinese economy, we did saw safe haven demand coming onto the market for bullion over the last couple of days. But overall, my view is that the medium to long-term trend still remains slightly bearish for bullion, and the dollar one day or the other would start having the strength because of the Fed interest rate hike. Although the September meeting does not look like to be having that hike stance, but I think by December the Fed may go into for a hike, and as Jim rightly pointed out, the crude also somehow can be bottoming out at around $40 level. So with inflation slightly low and the developed countries not doing too great except for the US, and at the same time the emerging markets also some kind in a problem with respect to growth and the demand for commodities, I think the US may hold on to this the Fed monetary policy tightening at least for the September meeting. But intraday, I think somebody wants to trade and buy it at a lower level of around 26,250 or so on the MCX with a target of around 26,500, and we are expecting stop loss for this particular trade to be put in at around 26,150. You asked me about the base metal pack. I think the markets are oversupplied. The China is the largest consumer of the base metal pack, and till the market and the economy does not stabilize there, people don't have too much of a great expectation to go into investments, and therefore the demand for the base metal pack would be slightly low. We are seeing the upside today just for a simple reason of kind of a sentiment booster of what the government in China did, or the People Bank of China took for the monetary easing stance. So with sentiments
sure,
going
but Navin,
up,
are you calling it a relief rally? Are you calling it a relief rally, bargain buying, or a dead cat bounce?
I think so, Manisha. I think it's a relief rally. Somebody wants to jump into and do some for a long-term basis in terms of base metal pack. I think he has to, or the investor has to hold across. Maybe we may see lows from here, but I think let's wait and watch and don't be in a hurry to get into this particular strength of today and get into a bullish mode, because the fundamentals are negative for the base metal pack.
Let's get in one more voice, and Bernard now joins us. He is a precious metal analyst at Natixis. Bernard, hi, thank you so much for taking time. What's your sense on what really the gold prices seem to be doing? Because we have been very volatile. We saw 3-month highs, and today has been a 1-week lows. Where do you see a range forming?
Basically, our forecast for the year as a whole is 1110, and we think that once the Fed will rise the interests, the gold prices could potentially drop below $1,000 an ounce. For next year, our forecast is probably $950 an ounce.
But not between gold and silver, which one would you want to pick up? Because there are many people who are betting more on silver than gold.
Yes, I mean, it's a tricky one, because usually there is a strong correlation between gold and silver, and when the price of gold drops, the price of silver goes down more quickly, percentage-wise, and then when the price of gold goes up, silver goes up more quickly, percentage-wise, typically. That said, if I could suggest a third alternative in terms of precious metals, I personally would choose platinum, actually. I'm quite bearish on gold, so I'm bearish on silver, and I think platinum has the most potential for the upside, because prices are currently below the cash cost of production for most of the South African producers. So I think platinum prices can have much more space to go up whereas gold and silver prices have still a lot of space to go down, especially that the cash cost of production for gold is probably $700 an ounce, and for silver in the area of $7 an ounce.
That's quite a bearish call, really, Bernard. But what's your sense on the Asian demand? Because China and India really stand tall when it comes to a physical demand. Do you see that reviving in 2015 now?
I mean, yes, it's very important to look at the Asian demand generally, because something like 52% of global demand for gold comes, 70% almost from global demand of gold comes from Asia, almost 50%, 48% from India and China together. When it comes to China, I don't think we're going to, demand for gold from China has dropped considerably. If you look at the June import figures, they're down by 40% year-on-year. Second quarter investment demand for gold in China is down by 25% year-on-year. We have seen improvements in India when it comes to imports of gold. That said, I think we could get much more of a boost if the import tariffs are raised. I'm interested to see if eventually they will be raised sooner, I hope, especially maybe with the help that India is getting with the fact that oil prices are lower, so that should help the current account deficit, which is the whole point of having these gold imports tariffs.
Well said, Bernard. Yes, we have been all waiting for that import duty to come down. But thank you so much, and really appreciate you taking time out for us and explaining the whole sector to us. Let's also get in one more voice, and Hen Potts, Director, Wealth and Investment Management, Barclays, now joins us. Hank, hi, thank you so much. What's your sense on gold prices as they settle after reacting to China, devaluation, subsequent rate cut as well?
We've been more cautious on gold than many investment houses for some time. We know it's an area that investors like to go into during times of economic uncertainty. We have seen a reaction from China a little bit in the short term. I think the long-term fundamentals don't suggest that gold prices are going to go back to that record levels of $1,920 an ounce that we saw back in September 2011. Investors really drove up the gold price during the course of that time. In fact, as investors accounted for 40% of total demand back in 2011. I don't think we're going to see those levels. Investment demand still remains relatively low. If you look at coins, if you look at bars, if you look at ETFs, actually not attracting investors in the same way that they did after the financial crisis. Alongside that, we know that jewellery demand has been coming under pressure. The key areas for jewellery demand include the likes of India and China. Slower growth in China, of course, has been discouraging consumers to be buying gold, at least in the short term there. In fact, if you look at jewellery demand, it fell 8% in the first half of this year. Some central bank buying has been supportive, particularly from some of the Asian central banks. Russian central bank has been buying some there. But actually, if you look at output, it's been rising. Output rose a further 2% from the mines last year. That's for the 6th consecutive year, up to a record level. So I think put that all together, we don't expect a big rally in gold prices anytime soon. In fact, we expect gold to average $1,215 an ounce during the course of 2016.
That's the view coming in from Barclays then. Not a major rally expected, except in 2016, where you could see prices gain up by nearly $200, but that's nearly next year. Sanjeev, coming to you, the Indian demand is expected to pick up as we head into festivities starting this weekend. What's your sense? Are we really adding to that physical demand, and would that support prices?
Yes. In fact, I was on your channel a few weeks back, if I remember right, and we were talking about the fact that the gold prices have corrected. It's a good time to buy. Since then, the gold prices have gone up vis-a-vis the rupee. So even if the international market gold price corrects a little further, the question is against the rupee, it might not. And hence, going forward, if there is a drop in the rupee value of gold, even a marginal drop by about 2-3%, I see a significant increase in demand for jewelry as we go forward.
Fair point that. But before we end the show, quick final comment from you, Navin. And what's your sense? Where would you want to put your money for rest of 2015? Is it going to be base metals, or is it going to be gold or silver?
Manisha, I will go with silver if you're giving me a choice between the precious metal and the base metals. And out of that precious metal, yes, silver can be one of the choices. The other one, as rightly pointed out, is platinum for all the fundamental reasons we discussed just now. I think platinum and second on silver we would go in rather than going in for base metal as of now.
All right, so silver is really the choice coming in from all of experts, but for the near term, it still is very volatile, is also the view from all of that. With that, Sanjeev, Hank and Naveen, we'll let you go. Thank you so much for coming by and giving us your sense on all of those commodities. With that, completely out of time on the show. Thank you for watching.